So, hi everyone, I'm Ian from ShiftAlt Capital. I will be the host for today's podcast. And today we'll be discussing how to look at investment holistically. We have our co founders, Anurag and Himanshu, here. Speaking about Anurag, he's a chartered accountant with over 30 years of CXO level leadership across banking, investment, and insurance. Was part of HDFC Mutual Fund's founding team, led wealth management at Citigroup, and managed public portfolios for ULIPs at New York Life. And along with Anurag, we have Himanshu, who's also a chartered accountant and former senior VP at Cognizant, where he led the digital business unit service clients, having clients including Alphabet, Microsoft, Meta, Apple, and Stripe. So before we start, we'll just be discussing on around a few topics, and we'll be starting with the overall holistic view on how, say, for example, if we have a portfolio that is diversified, what does that actually mean, and what does it cover in terms of funds, different assets, or different countries? So over to you, Anurag and Himanshu.
Thank you so much, Ian. Thank you for organizing this podcast. I really appreciate it. Coming to your question, what is diversification? Essentially, the way I look at it is most people inadvertently simply collect assets, property, fixed deposits, mutual funds, equities, some gold and silver. They just collect them. Collecting assets is not diversification. That is essentially putting together political and geographical concentration. Diversification means diversifying beyond geographies, beyond politics, and also beyond economics.
I also think, Anurag, that when we talk about diversification, I think the common question people ask is, how do I increase my diversification? Also, how do I increase my return? I think the other angle I think all of us should follow is diversification also means how do I manage my risk better?
Right.
Because it's as much about preservation of your wealth as much as return, right? So I think diversification to my head is also about managing risk very actively. And if I look at any institutions, if we try to mirror what a large family office or a large FIR will do, they will not ask a question is where is the next stock coming from, which is a stock which is going to gain momentum and where should I invest? It will not. I mean, they may say Nvidia is awesome, but the allocation will be like 2%. Nobody's putting 20% Nvidia, right? The reason is that you want to manage your risk, you want to manage volatility, right? That's really the intent behind these FIIs or the family offices, how they think, right? So it's always about looking at assets which are uncorrelated, assets which move differently. It's always about managing that drawdown for yourself, right? That's a true diversification, and I think it's also about ensuring that your asset represents a broad set of activity which is happening across the planet.
Correct.
Yeah, I agree. In fact, I would also expand on what is meant by geographical, political, and economic diversification in the sense that classically we were told by our grandmothers in a very rudimentary way that don't put all eggs in the same basket. But essentially, what we end up doing is we put our eggs into different baskets, but the basket itself is in Indian. So we
Right.
need to also create other baskets. Now the world is very interconnected. The economies are interconnected. The politics are interconnected. Once something happens in one country, it affects another country.
Very good point.
Now, how do you de-risk that impact? So if the only basket you have is in India and all your eggs are in that one basket, what if the economy struggles? What if the economy suffers?
And we are seeing it now, right?
Yeah, we're seeing it now in the last
Seeing it
1 to 2 years. In fact, I was just looking at the stock markets yesterday. Exactly 2 years ago, 1st June 2024 and 1st June 2026, stock market in Nifty 50 is exactly the same, point to point. And I was very surprised. Wow, were they measuring the calendar?
Yeah,
That's an
currency is
interesting
another
take.
angle which none of us talk about, right? I mean, we are seeing it now as it's playing out in Indian market. I mean, in dollar terms, the returns are actually zero to negative for most foreign institutions, right? So in some sense, currency will be a big part of how money moves across the world and your own returns, right? So I think most of us don't give enough weightage to that aspect, isn't it?
I mean, I was looking at some data in the last 1 year. Nifty 50 has given a return of minus 5.2%. In the
In dollar
same period,
terms.
and in the same period, S&P 500, the index, has given a return of plus 19%. Now, this is without looking at the currency appreciation.
Yeah.
So it makes sense to put eggs into different baskets.
I like the lens and actually looking into when people mostly speak about it, they only speak about different allocation of funds. But then with the lens of actually looking across that and even considering different countries, that's my takeaway from what I heard from you, Anurag and Himanshu. And also, if we look at the situation, for example, if we only look at the Indian market, if a hypothetical situation as such, that if the funds were frozen for 3 years, what would you actually do in that scenario? Like, what would you consider, and how would you get out from there?
I mean, it's a very unlikely scenario, right? I mean, to be honest, I mean, would Indian government ever get into that? Because that means you are. See, one of the biggest advantages US has that it's the regulatory systems are very strong, which is probably one of the reasons why it attracts a lot of capital. And India is still getting there, but if they were to freeze, it will be going backwards. Like, if the law of land is unpredictable, you will have troubles. I know you might find differently, but I'll be very surprised if something like that happens. I mean, isn't it?
Yeah, so in fact, I second that thought. If you look at the data, India is growing at 7% GDP, right? So if the stock market is not growing, there have to be some other reasons. So so it is a very hypothetical question that the Indian market gets frozen for 3 years. But assuming it gets frozen for 2 or 3 years, like we looked at the data, 2 years the stock market is absolutely flat, point to point. Now, if it were to be frozen for 2 to 3 years, conceptually, what I would do is I would break my portfolio into three parts. I would first preserve my capital by putting something into cash and something into debt markets. This is basically to protect the downside, but it does not even cover the inflation. So what I will do is I'll put good chunk, maybe 25%, maybe 40% of my money into different markets which are growing. If Indian market is not delivering returns, I will put some money into global markets and I will activate that.
Who knew that Brazil will go into the tailspin the way it went?
Yeah.
I mean, Japan. If you are an investor in Japan, you probably had to wait for a decade for some return to come in. So it's not as hypothetical a question as we all think it is, right? It is real. It happened in Japan. It happened
Yeah.
in China.
Yeah, it happened.
It happened in Brazil. So these are all large economies where it is happening, right? So I think those are real scenarios we are dealing with, isn't it?
And I think also Anurag also rightly mentioned that we're not just here to beat the inflation, right? You have to see the growth, and that's how the diversification actually helps. So anything to highlight on those points, Anurag and Himanshu?
So I think beating inflation is a defensive posture, right? You're basically trying to just play defensive, catching up with inflation just to preserve your capital. That is defensive. And offensive is essentially true wealth creation. And that happens when you get into those sectors, get into those economies, get into those businesses which are growing crazily. And there have to be reasons why they're growing crazily. To my mind, playing defensive is actually just trying to prevent erosion. Yeah, but going back to your previous point about inflation and about the fact that uh, headwinds can happen anytime. So inflation can happen anytime.
Right. Thanks for sharing, Anurag. So one other question that we always get, Anurag and Himanshu, is many of our audiences believe that, if India is growing at 7%, we always see the news, right? India is growing at 7%. So you highlighted that, why it's important to move away from the country when you also speak about diversification, not putting India down. But when we are saying that if India is growing at 7%, why do we need the global market? Why do we need US? So what is your take on that?
Many people ask this question, and people with some seriously global perspectives. I guess it's the bias that, I feel comfortable investing in geography, which I understand. And that's just too much, right? But think about it, right? Every geography has a role to play. And I think that is the key point. Like, for example, US has a role to play in innovation. I don't think any country in the world can compete with that. The talent, capital flows, regulatory setup. US has like hundreds of years of advantage over the world. So if you were to follow what you just said, you miss that entire basket of innovation which is happening. Now, China has a manufacturing play in the world.
Yeah.
It is the manufacturing world. So if you don't invest, you miss the entire manufacturing boom which came, right? Similarly, Brazil has a commodities play. So I guess the point is that just thinking of one geography is a very myopic way of thinking. India is a consumption play, which is why people invest in banks, consumption stocks, IT. Those are the ones which are always on the spotlight, right? When India is concerned. But the point I think is that every part of the planet has a USP. And not putting money in your USPs, you are basically A, missing the wave, you're B, missing the growth potential, and C, you're seriously risking your portfolio.
The other thing which I would like to say here is just look at the size. The global economy today, the market cap of the world is $127 trillion as we speak. India is $4.8 trillion market cap out of
I think
127.
South Korea today surpassed us, right?
Yes, 5.1.
South Korea.
And guess what? The US market cap is $77 trillion. Only NYSE is 44. Only NYSE is 44. When you look at the whole US, it is 77. If 77 trillion of your 127 world, how do you miss it? How do you not ride on that? The cost of exclusion, the cost of not investing in the US is humongous. The kind of monopolistic tendencies that American companies have is rare to find in India. So it is something which is like the innovation and the scale. How do you not invest in that? The cost of excluding this will be felt if you in your portfolio immediately.
So it would be right to say that if we are not investing in the US market, we are missing out on the global growth, if we put it in that way.
I mean, right now, AI is taking the world by storm. Give me one AI company which is coming out of India. There will be a bunch of startups which are building on top of AI, LLMs created by US, but the entire ecosystem of AI is built in US. I mean, whether it's chip infrastructure, whether it's energy infrastructure, whether it's the LLM infrastructure, it's all being built there. And I think sooner or later we'll all copy it. I mean, China has started that, but fact remains that the whole infrastructure sits there.
Yeah, and the products that you consume, that we all consume every day, all these companies are listed in the US, not in India.
Right.
I mean, it's a fact. They're not listed in India.
So far, we have been consumers, but now we need to be a profitable consumer.
I mean, if we just look at when we consume American products, either we are giving them a money or we are giving them a data which they sell to make money.
Right.
What are we getting out of it? So if we invest in those companies, we at least get some share of profit.
Absolutely. So, and also, Anurag and Himanshu, thank you for addressing that question about the growth and why it makes sense to invest in US. But when also we speak about the apps, like you rightly said about monitoring US markets. So what are the platforms do you regularly watch, and how do you get an idea of these companies that are listed? Which devices or apps do you refer to?
Assuming an average investor, and with Joe, is going to struggle with doing all of this, a good start point is find a platform, and there are dozen these days, right? I mean, there's Borderless, there is, I think, Grow has their own, there are dozen, and Anurag, probably you can fill this in. There are dozen such platform which will facilitate your pipe. Now, you could actually just pick up S&P 500 or a Nasdaq 100, and or if you're very bullish on the AI, just pick up an ETF. You don't have time to research companies, don't have time to exit. Just pick up a ETF of the broad ETF or a sectoral ETF you want, right? And that's a good way to start, I would think. So looking at holistic investment. And I think this is where return comparison is awesome. But I think other way to look at it is that if you had invested 10 lakhs in, let's assume for a minute that you're a believer in holistic investment, and you put 10 lakhs in S&P, and you put 10 lakhs in Nifty. A, you would have got a higher return on an average, and B, you would have reduced your drawdown periods dramatically. I don't have data handy, but I reckon the periods in which you have to suffer downturns would have at least come down by half. So you're managing volatility much better, as we had started the original topic, right?
Right.
And if you were smart enough, and if you had, let's say, put in something in Japan and China, maybe 5%, you would have seen even lower tenure of drawdowns and a higher average this thing. So, and obviously the fun of boasting that I do have Nvidia in my stocks, right? Portfolio. So minus that fun, I think the holistic thing is one, I think, which we are on the right track with that.
Right. Also, like when Himanshu, when you spoke about preserving wealth and parking the money in a stable economy, what we have seen in the past is that when rupee to dollar, the amount was 45 in 2011, and today it's almost touching 96. So even if someone would have held the money in dollars, it would still make a big difference, right? So what has your experience been with the clients that you work with, and what difference have you seen in that for accommodating this difference in value of money as well?
It's strange that we don't understand erosion and how different currencies operate. I think it's also we don't understand that our world is interlinked. Most of our children don't study in India, right? We travel a lot, so we don't understand that while we are living and earning in one currency, we're actually spending money in another currency, and this actually hits us in multiple ways. less than 5%, I would think, of our customers, I think, who have shown deep understanding of the situation.
Anurag, also, since we are speaking about global currencies, I know that you work with not just Indians, but also interact with a lot of NRIs. So, what do you see them doing? Like people who are earning in dirhams or pounds, and what do you see them doing? Like, do they convert the money back into rupees, or which other route do they take for investments?
So what I see is a very clear two buckets. I can put the behavior into two buckets. One bucket is the old bucket, which is the slightly elder, above 40, 45 kind of people who have a very, very strong home bias. I mean, I have a few clients in Middle East, and they would bring the money back to India, buy real estate, buy gold, put into fixed deposits. Not even equities or mutual funds. That is a home bias. When they could have invested into dollars, they did not. The second bucket, which I see behavior, is people who are typically below 40. They are more open to global investing. And they actually say they realize that as NRIs, if they're earning in dollars, why should they not be investing in dollars? And
Right.
there I see they are more open. This is what I call the modern HNI shift.
Also, so like we spoke rightly about why global markets, why US makes sense. And the other focus is more on the kind of behavior that we are looking around investors. So, what do you think their behavior usually is? Are they open to more of, like when we point out three options, is it more on just investing on brand names, which makes sense, or maybe in index funds, or is it directly just choose an ETF and be safe? So, what do you see that happening, and what are the mistakes people usually make?
I basically see three things people do. The first one I call the brand trap, right? So that is what people do. They collect brands, the shares of those brands, and nothing wrong with this approach, except that there is no research, there is no analysis, there is no logic that goes into when to buy, when to sell, what to buy, right? That kind of that is what is called the familiarity trap. The second approach which I've seen is, why should we put so much brains into it? Why do we analyze so much? Simply buy the index. And when they buy the index, their money grows with the index. But when the index turns, they also suffer. So, for example, if you look at the S&P 500 today, it is unusually driven by the mega tech stocks. Mega tech stocks. Now, those mega tech stocks are having an over disproportionate weight in the index as of now because S&P 500 is driven by market cap. If you look back at 2022, what had happened then? People who were invested into the indices versus people who were invested into the tech stocks directly. The S&P 500 fell by 19% in 2022. The tech stocks fell by 31%. They had taken the first approach, which is buy the brands that they understand, by the tech stocks, which are like the hot thing. Their portfolios would have fallen 31%. But if they had bought index, they would have fallen lesser at 19%. I mean, this basically shows the classic difference when the drawdown happens. And the third approach, which I look at, is ETF collector. There's a very popular website called ETF.com. People just go and buy ETFs from there. They read about ETFs, they like the ETF, they go and buy. Again, the way to analyze an ETF is very different from the way you analyze a stock. But between these three approaches, nobody looks at how to structure the portfolio in the right way.
The fact remains that portfolios are the only way to look at it because risk management should be our primary goal, along with increase in returns, right? And we should actively look at correlation among assets. We should actively look at diversification of our risk. I think, to my mind, that risk is a very, very big factor which we ignore all the time. I mean, even if you, like I was saying in the beginning of the call, as an FI, even if they love Nvidia, have all kind of information pumping in, the investment will not be 20% in one stock. It will only be 2%. It's the discipline. It's the philosophy of uncorrelation, diversification, which plays out. And I think as HNIs, as investors, we should all follow those principles.
Yeah.
Got it. So I think overall there is not just one safe answer, right? So many people think that, there's just one thing that we can do. Like when we speak about pure index, there's a safe way, but then that's just putting you on a track to underperform, right? So if an Indian investor who's just exploring the US market, what would be your advice to them from what we have already spoken in simple ways?
I mean, in simple words, look, it's good to start with ETFs. But we have to learn to layer our portfolios, and we should begin to look at a base investment, which is a broad-based ETF, and then start to also build layers of sectors which are really, really the sector for future, right? I mean, right now, no rocket science says AIs and defense are the sector of the future, right? So we start to layer, and then probably you should look at a few stocks which you think are really catching momentum. And I forgot, along in your broad-based biggest layer, I think you should also put some treasury bills and some of those investments also. So I guess what we are heading towards is a portfolio which has a fixed income, a broad market, a sector, and a few stocks, all built into one.
Got it. I like the approach. I think that's music to my ears to listening about how we can safeguard our investments and using the layering method. So if we take a situation like, say, for example, we have 10 lakh rupees and need that to be invested. So how would you build that portfolio?
So I would talk about the layered approach that Himanshu talked about in a very different way. You see, to give a simple analogy that anybody can understand, what is a layered approach? Layered approach is, think of it like a house, right? There is a foundation, there are walls and pillars which hold the roof, and then there's the roof. Now, the analogy here is that the roof is the shiny thing on the horizon, which is the tech stocks which are delivering high returns.
Got it.
But if something happens to those drivers, then it is and if you're not focused on building the foundation or the walls, then if the roof is literally floating in air, if it crashes, everything crashes. So what is the foundation? What is the walls? If you start looking at that, what is the foundation? The foundation for me is a defensive low correlation layer, which comprises of things like inflation index ETFs or inflation index bonds or treasury bills, which basically lay a very strong foundation. It also acts as a protection, or protection is a very strong word. I would say preservation of capital. This layer could be between 10 to 30% of the allocation, which essentially ensures that in case the market turns, this layer is what will offset the fall in the market and hence reduce the drawdown. The second layer, which is walls and the pillars, what are they? They're basically those businesses which are driven by quality and value. So those businesses which are having a lot of cash inflow from their sales, those businesses which are essentially built on perennial demand, their demand does not get affected by either rain or sun or war or peace.
McDonald's. A good example.
Like food businesses, funeral businesses, or logistic businesses. There are those businesses which keep moving things, which keep having a cash inflow. Distribution businesses, those businesses. And then there is the roof. Now, if you have a structure like this, the foundation, the walls and the pillars and the roof, that is what I call a layered approach in a simple analogy. Now, what Himanshu talked about, we have about 20 to 25% in the foundation. We have about another 40%, 35 to 40% in the walls and the pillars. And then we have another 35% spread across not just the globe, not just emerging economies, but also emergent, the developed economies like China, Japan, US. And we also have hugely momentum driven stocks or ETFs and those stocks which are building businesses of tomorrow. So that layer, that pyramid that we typically show on our website also, that is a very graphical representation of what a layered approach is and how a house would look like.
Absolutely. And I think in the past few years, we have also seen people that have just gone on investing with brands and how it impacted them, whereas in comparison to having a layered approach, right? There has been such situations
Look, it's
that you would like. Yeah.
it's very difficult to track a stock. Nvidia has gone to the point which it has gone to. If AI doesn't live the promise of automation, you will see, we'll all see a massive tumble down on stock prices, right? The bets have been heavy, the tumble down will be as heavy, right? So,
Right.
and it's very hard for any of us to calculate or understand those risks. They are known to nobody, right? I mean, except maybe a handful of people in NVIDIA and maybe Sam Altman and others. These risks are not known to public. So I think it's just a bad idea to build your portfolio on a few. Yeah.
And also a lot of the investors who don't have, they are not exposed to the US market. They have this question that I don't understand the US market very well enough. So how will the layered approach help me? Like, will it reduce the risk or will it add to it? So what is your take on that,
I think
Himanshu?
the risk is measured by Sharp, right? And maybe Anurag, you're master of these numbers. And there are two measures which, parameters we measure, Sharp and Sortino, right? And I think
Sharp, you measure a whole lot of things, but Sharp and Sortino are the big ones.
yeah, and I think any number of one is a good. I think if you do these layered approaches, I think you're looking at a Sharp ratio more than or closer to two, right?
Yeah.
Yeah. So this is the mathematical representation of what you could get. You literally reduce your risk. Yeah.
Just to give you a perspective, if you don't follow this, the Sharp ratio will be less than 1. That is a very good thumb rule. Just ask for the Sharp ratio of a portfolio. What is the Sharp? So Indian mutual funds, for example, about 80 to 90% of the Indian mutual funds have a Sharp ratio of less than 1. Even in the US, a good number of funds have a Sharp ratio of less than 1. So to be able to deliver a Sharp ratio of more than 1, and especially in our case, for example, closer to 2, that basically means that for every dollar of risk you're taking, you're getting twice the return.
And that is possible only with layering and uncorrelation. It's not possible any other way.
And also, a lot of our viewers, many of them that we interact with, they are having RSUs from their employer. So, what is the biggest risk that they are exposed to that you would like to share about?
I've been in that boat myself. And honestly, believe it or not, at some point in time, a very significant portion of my own wealth was tied up in RSUs. Then you realize that you work there and your future wealth is also tied to your stocks, and something happens. A lot of managing directors of the company had their salaries wipe out and plus their stocks wipe out. Because
Right.
even if you believe in the company, you can never predict how the market or the economy around you will hit you.
But on the other hand, if I look at today, what has happened since November 2025, when the agentic AI came out, when the some of these AIs they brought out very powerful agentics. What has happened is that a lot of the ITES companies and the IT companies, just look at their stocks in the last 5 months, they have suffered losses from 20% to 50%.
Yeah.
The value of the stock. So, and I have clients who have 30%, 25% of their net worth into one stock. So I asked them a very simple question. If you had cash, if you had this cash, would you invest into one stock? And the answer always is it's like a bulb going off in their eyes. Wow.
Right.
And that's when they realize that they're sitting on a very big risk. Because sometimes when you tell them, they are so passionate about their company that they don't realize that my employer is also my biggest risk.
Correct.
If I tell them like this, they will not even listen to what I'm saying. But the moment I ask them, the question that I ask them, it really hits them.
It's a good eye opener.
Looking at simple allocation principles, nothing wrong with holding 5% of your net worth into one stock, which is your employer. 5% is fine. More than 5% is not fine.
You know, when business models are challenged, you can see stocks languish for years together. And they languish because I think the investors have moved on. The company may not have actually done badly. Look at some of the results. The cash flow will be positive. EBITDA will be growing at a high single digit. Everything is fine. But just that the investors have lost interest because investors invest in future. They don't invest in companies which are being threatened today, right? Now
Yeah.
they've lost interest. The money is moved there, and you are left holding your little hope.
This kind of thing happens, and yeah, RSUs are there. People need to figure out that look, this is their wealth. This is not their salary. The
Yeah.
salary, the dynamics of salary and the dynamics of wealth are very different.
I think
Absolutely.
that the important point is the wealth. If all of some of us who were lucky enough to generate wealth, I mean, I think our job should be to preserve it as much as to grow it.
Yes, very rightly said. And that is why on our website we say that we basically try to preserve our capital, investors' capital. We basically optimize against loss. The exact words we use on our website is we optimize against loss.
That makes sense. And also, Anurag, a lot of them have a question, like all of our viewers, they have a question that if we have to see some difference or when we are exploring the US market, what is the minimum amount that we should be looking at? Is it like deploying a lot of crores or is it uh, somewhere around in a certain lakhs of rupees? But what would you suggest that people should look at?
So, I would say don't look at it in the number of rupees or dollars. Look at it as a percentage of your net worth. If your net worth is 100, whatever that 100 is, ideally you should start with maybe 3, 4, 5, 6% of your net worth into US markets, but build it up to about 20%.
Yeah, and just a correction. US means global market.
Yeah,
Yes.
but thanks for the correction.
And also, like, since we have discussed a lot and about what the kind of portfolio should be, what the allocation should be, what are the mistakes that you usually see, like investors keep doing? Like, what are when we speak about three traps that they should avoid, what would that be, Himachal and Anurag?
Now, I was saying that we talked about it. I think stock picking is one, anti-diversification is second big mistakes. Familiarity bias and Rock talked about is the third we have seen. Those are my three of my favorites, right?
And I have one more, which is called analysis paralysis, which is basically I will learn more and then I will invest. So a lot of the senior executives and business owners, they're intelligent people, which is why they're at that level, right? Now they have this bias that we'll first learn, we'll first read 5 books, we'll learn, and then we'll invest. That never happens. Analysis paralysis also has this another aspect, which is the cost of waiting. So if you wait too long, you suffer. Start small, and gradually build it up.
And Anurag, since that you have been following this layered approach for quite some time, Himachal, as well. So, what is the kind of returns that you have seen in the past by following the layered approach?
I think the returns will always be above the S&P,
Yeah.
over to a benchmark. And more importantly, the Sharpe ratio has always been closer to 2. Look, I don't think it's a good idea to quote numbers because stock markets are volatile, but definitely I think we would have gone ahead of the S&P performance, Nifty's performance, and managed the risk far better than any of the indexes.
Got it. So while we are ending towards the discussion, any takeaways that you would like to share with the audience from what we have discussed?
I mean, I think
And
Anurag
next
said
steps.
it, right? Analysis by paralysis. Or rather, other way around, I think. Paralysis of analysis, right? I think start. I mean, it's unfamiliar. We all understand that it's familiar to invest in companies which are known to you in a country, but I think it's time to take a good step, time to look at what is getting created outside of our country and take advantage of that, right?
Biases that we've observed, it is important to overcome those biases, including the home bias, including the bias of complexity of process. How will I handle the taxes? How will the process work? See, there are chartered accountants who are practicing whose job it is to manage the complexity and the process, right? Or the taxes. You get onto these platforms, they manage the process, the complexity, the four platforms that I had mentioned. So don't try to do everything like handle the taxes yourself, handling the process yourself. Let people who are competent and experts in their fields, let them handle what they are competent and experts at. You focus on what you want and let them handle the process, let them handle the taxes. And the most important thing is overcome the execution inertia. I see this quite a lot, which is analysis paralysis. It is also leading to the execution inertia. They just kind of drag their feet because it is an unknown territory. Start small.
Right. Interesting. So I think we had this wonderful session. Thanks, Himanshu and Anurag. You covered everything really well. I'm sure a lot of your viewers learned a lot. And what we covered today was mostly around the what and the why. And in the next session, we'll be covering to get into the how. For example, what are the NRI account structures, tax treatment, position sizing, and how to rebalance, when to rebalance. And for all of the viewers, if there is anything more that you would like to know from us or anything that you want to cover in the next video, please drop a comment. Thank you.